Unlike a lot of investors in the younger generations, I am not here to get rich quick. Now, do I want to be rich quick? Sure, that'd be phenomenal. But it's just not likely with my level of risk tolerance. So what I'm doing is I am on a mission to find the absolute best performing dividend stocks and ETFs that will get me there in 10, 20, even 30 years. I'd be happy. My goal, I would love to live off of dividends, actually. That would definitely be my goal. But of course, to do that, I would need well over $1 million and some luck. So here's what I'm doing. This whole video series that I'm starting is going to be on my absolute favorite dividend stocks and ETFs. Now, this is all my personal opinion. It's not financial advice, but I hope you guys enjoyed this style of content. These are not ones that are going to pay you 3x your investment in a year or two. These are ones that are slow growth with the power of compounding that could make a massive difference in you living off your investments and potentially even retiring early. So I hope you guys enjoy. If retiring early sounds good, if dividend income sounds good, you are in the right place. So don't forget to like the video and to subscribe so you never miss an update and you don't miss out on stocks that could slowly make you rich. Let's roll that intro. Ares Capital Corporation, or ticker ARCC, is one of the larger BDCs, or business development companies. I know I'm coming at you with a lot of acronyms right off the bat, but let's talk about this. PE ratio of 11 and a dividend yield of just under 9%, which alone is pretty average in the stock market. I'd be happy with that every single year compounded, but that's not all that ARCC does. It is only up 0.5% year to date. If we go to the 1 year, it's up 3%. The 5 year, it's up 50%, but it did have an absolute crazy jump after 2020, like a lot of the market did. We go to the max chart and it's not the prettiest. It's up 43, almost 44%, which is still good, but it's been trading since 2004. So it's over 20 years. And now what this means is that ARCC, the price of the stock is not what's going to make you rich. It's not what you're going to live off of. What you're going to live off of is that 9% dividend yield. And of course, that is why the price of the company is not skyrocketing over time, because they do pay out high, consistent dividends. And I'm okay with that. Some people might not be. I do like some that can do growth as well as solid dividends. But when it comes to ARCC, I'm just a fan. I definitely will say I'm biased. It's one of the largest positions in my portfolio. And I think that if you're interested in consistent dividends with a little bit of growth thrown in there, the power of compounding with this stock can take you to retirement earlier. It can take you to living off your dividends earlier. And it can take you to grow your portfolio earlier, no matter what the market is doing, really. Because if you're just depending on growth, you can have some times in the market where things trade sideways, doesn't go up, it doesn't go down, or it does with little volatility, and you're not really making a lot of money on your growth. And that's where these style of dividend stocks really shine on top of the normal compounding effect that we get with the dividends. And if you don't believe me, I'm going to pull up the drip calculator at the end, and I guarantee the average annual total return that you would have gotten had you invested in 2004 is going to blow your mind. But first, let's jump into their portfolio and see what this company is made of. One thing I will say that's going to impact this company greatly is interest rates. I mean, the amount of money they're going to make is probably tied pretty steadily to interest rates. They don't do a lot of floating rate loans, meaning the rates follow whatever the current rate is. They do more secured loans, which I am happy with, and it gives us more of a prediction depending on how interest rates are doing, where right now they probably have some older loans they're not getting a lot of money on that once they restructure, they will. And we can see they have first lien senior secured loans. It's about 60%, which are safer. It just means that if the company goes under, if bad things happen, ARCC is paid out sooner. Second lien senior, 5.7%. And then it goes on to a number of other senior subordinated preferred equity securities. And then other equity securities is about 10%. The industry composition, which is what I think is really important, is wow. I mean, software services is almost 24%. I'm a big fan of software services. It might not be the shiniest, the newest. It's not just AI, but it is tied into all of these shiny and new things. So I think that is really, really important. We have healthcare equipment, commercial and professional services, insurance, consumer services, blah, blah, blah. There's a lot. I really recommend checking out the website for yourself if you are interested in investing in this company. But I mean, just look at the pie chart. It just shows that it is very, very diversified, but it's heavy in software and services, which I'm okay with. Geographic composition, all within the U.S. It seems, besides 6.2% international. The West, Midwest, Southeast, Mid-Atlantic, Northeast, all of which I'm okay with. I don't really have a personal opinion on the geographic composition of these. It really depends on the overall market and how things are going. But I do like it when the Pacific side, when we are looking at the West Coast, just because we have Los Angeles. It's very tech heavy, very business heavy. But either way, it's looking pretty solid. So happy about that. So I was actually wrong earlier. This isn't one of the largest. It is the largest business development company. And here's a little sneak peek of what the drip calculator is going to show us. The annual shareholder return since the IPO is 13%. You are getting 13% on your investment every single year. That compounded over even a decade is phenomenal returns. Total investments, $27.1 billion, portfolio companies, 566, and a market cap of $12.5 billion. They have a bunch more information on their press releases and whatnot. So again, if you are interested, check this company out and let me know in the comments, but we're not done yet. We have to check one of the most important parts of a dividend stock's history, the dividend history. Now, one thing I will note that is one of the cons of ARCC is the dividend growth has been slow. We're going to check that out, but we're on Seeking Alpha right now, and we can see the growth of the dividend was really solid until the end of 2022, where it kind of just fell flat. We have actually not really seen any dividend growth from 2022, so the 3-year CAGR, or compound annual growth rate, is not going to look too good. But we can see before that, it did have some solid growth. And I like the chart for this because we can see even on the 10-year, this thing was continually paying out and increasing. Now, a lot of these increases, like this wasn't a dividend cut. It was because it paid a special dividend in 2022, which is interesting. We haven't seen a special dividend, I think, since 2022, which is a bit of a bummer. But it's nice that they were paying some special dividends. When we jump to the dividend scorecard, we can see the dividend yield of, 8.74%. Forward payout is $1.92, and the dividend growth is a D rating because that 1 year is at 0. It has not grown the dividend at all over the last 3 years, which is a downside. I'm not going to sugarcoat it. That is not good, but I do still have hope in this company because they were able to continually grow it for a long time. This is kind of a shaky spot. If you think they're going to come out of it, it could still be a good investment. If you don't think they're going to come out of it, it's going to get lower and lower on the yield every year, or at least just not grow. That comes down to your own beliefs and opinions, not financial advice, of course, but we can see the 5-year CAGR, 3.71%, which isn't great either. So even when it was growing, it wasn't growing at a remarkable point, but I will say this company is large. And when you are a large dividend paying company and more investors come in, it gets harder to maintain that continual growth rate. We've seen it with Realty Income compared to some of the other smaller REITs where they can have a CAGR of 10% a year because they can just funnel all their money. They're making more money. They're funneling it out in dividends, but the larger they get, the more money they have to pay out. And so they can't keep up that pace. But we can also see, the last 3 years, they still have a 5.4% CAGR, which isn't bad by any means. Should be a little bit higher. I'd like it to be a little bit higher, but the solidness of this company is what keeps me invested. It's not just the growth. It's one that I can hold on to and not be worried about. It's one that I would depend on in retirement if I was in retirement. And so that's definitely something that I think is a massive factor. Also, it does pay quarterly, which a lot of people might not like. We have monthly payers. We have weekly paying ETFs now, but I'm okay with quarterly. In retirement, it might be a little bit harder, but now I just get a nice check at the end of every quarter, 4 checks a year, and I'm definitely okay with that. The last thing we want to look at, though, is this drip calculator, because I guarantee you're going to be surprised by what you find. So I'm on dividendchannel.com. We can see ARCC is plugged in, and we're going to chart it from the initial time it started trading, which looks like was in October of 2004. Now, what we're looking at is just phenomenal returns, meaning over 20 and a half years, your $10,000 investment with dividends reinvested would be worth $123,000. And what's crazy with this, that is, you can't retire off of that money, but in 20 years, if you keep going and compounding that to 30 years, I guarantee you'd be close to retiring at least, or at least close to $1 million, probably well over actually. And so we can also see the total return, 1,132%, which is averaging just under 13% a year, like they had on their website, because that is something to boast about. That is not easy to do. I make a lot of content on a lot of different stocks, dividend stocks, growth stocks, and continuing to make your investors 13% a year is nearly unheard of. Don't take it from me. You can watch my other videos, watch other YouTubers, and let me know what you guys think. But that's phenomenal. Now, here's the key factor with this, though. DRIP is on. With dividend reinvestment not on, which that's what DRIP stands for, dividend reinvestment, meaning when you're paid a dividend, you immediately buy more of the company that paid you the dividend. The difference is astounding. You go from an over 1,100% return to a 266% return. You go from averaging a 13% average annual total return, beating the market by at least 1% on the best years of the market, to an average return of 6.5%. Less than half. About half, which is devastating. Your starting investment of $10,000 goes all the way to $36,000, meaning you're out about $90K from not having dividend reinvestment on, but you've still been paid out quite a bit of money. You've collected almost $33 in dividends per share over that time period, but it's not going back into the stock and it's not helping you grow. And so that is, again, the entire point of this series. Consistent dividends, consistent growth, if there is some, but all in all, just stocks that are going up and not rocketing up, but consistent payers. So I hope you guys enjoy this series. I don't even know what I'm going to name it yet. But again, if you like dividends, if you like ETFs, you are in the right place. Don't forget to like the video and to subscribe. And if you enjoyed this video, chances are you're going to like these that are popping up on your screen right now, including one on Devo and one on SCHD, which are two of the most popular dividend ETFs on the market. And let me tell you, the returns are phenomenal. So thank you guys so much for watching. I hope to see you in the next video.